In this video, we're taking a look at the alternate version of exercise 1-3 from page 36 of the textbook. This is chapter 1, Introducing Financial Statements. And here we're identifying the effects of transactions using the accounting equation. So the problem reads that Ming Chen began a professional practice on June 1st and plans to prepare financial statements at the end of each month. During June, Ming Chen, the owner, completed these transactions. And then here we're given a list of transactions A through J. Problem says arrange the following asset, liability, and equity titles in a table like Exhibit 1.9 from the textbook. Cash, account receivables, equipment, accounts payable, common stock, dividends, revenues, and expenses. Use the addition and subtraction to show the effects of the transactions on the individual items of the accounting equation. Show new balances after each transaction. So when you open up Connect, you'll already see this table displayed for you. And it shows the basic balance sheet equation, assets equal liabilities plus equity. Remember, another name for assets, economic resources, liabilities and equity, claims on the resources, and there's two types: creditor claims known as liabilities and stockholder claims known as stockholders' equity or simply equity. The balance sheet equation says at all times that assets must equal liabilities plus equity, or that economic resources must equal the claims on the resources. And in this transaction, we've kind of expanded what makes up assets for a company. Here we have listed cash, account receivables, and equipment. Claims that are creditor claims, we just have one group together called accounts payable. Stockholder claims are actually divided into four different categories now: common stock, dividends, revenues, and expenses. And when we take common stock minus dividends plus revenues minus expenses, that equals all of the stockholders' claims. So let's go ahead and take a look at the first transaction, transaction A. The problem reads, the owner invested $60,000 in cash in the company along with equipment that had a $15,000 market value in exchange for common stock. So when looking at this, the first thing to do is to think about what accounts from the balance sheet equation or the sub-accounts specifically were involved in this transaction. Then we're going to record those dollar amounts in those accounts or sub-accounts. So the owner invested $60,000 in cash. So recording this from the company's perspective, we know the company has more what? They've got more cash, $60,000 to be specific. What else does the company have more of? Well, they've got more equipment. They've got $15,000 more in equipment. And what did the company issue to the owner, the investor, as a result of this contribution of $60,000 of cash and $15,000 of equipment? They issued common stock. That's called contributed capital. So they have on record that the owner contributed capital to the company of $60,000 plus $15,000, or altogether common stock increased by $75,000. So that's how we record the first transaction. Cash went up by $60,000, equipment went up by $15,000, and contributed capital, aka common stock, increased by $75,000. Okay, let's take a look at part B. Part B says the company paid $15,000 cash for rent of office space for the month. So the company used up $15,000 of its cash for rent. Well, what is rent? Well, that's the type of expense that a company incurs on a month-to-month basis. So they have rent expense, and we know the two accounts involved in this transaction then were cash and expenses, specifically rent expense, but we just have one category called expenses that we'll dump it all into. So how much was cash? Did it go up or down? Well, cash went down by $15,000 and expenses went up by $15,000. Next, the problem said to total things along the way, so let's update our balances now. We have cash, $60,000 minus $1,500 is $58,500, plus equipment of $15,000, plus common stock of $75,000, plus expenses of $1,500. So we can take a look at this together and add up the left side, all of the assets, cash plus equipment, And know that our balance sheet equation is still in balance because 58,500 plus 15,000, well, that's 73,500 on the left-hand side of the balance sheet equation. On the right-hand side, we have 75,000 minus 1,500. That also equals 73,500. So our balance sheet equation is still in balance. Assets equal the claims on those assets, liabilities and equity claims. Let's move on to C. The company purchased 10,000 of additional equipment on credit, payment due in 30 days. Okay, so what's going on here? Well, they bought equipment, right? Did they use any cash? No, they're paying for that cash later on. So they've got an account that they're going to pay off later on. So what are the two accounts involved in this transaction? Well, equipment will be one, and then the other, an account payable. So equipment goes up by 10,000, and the account payable goes up by 10,000. We total things up, 58,500. The new equipment balance is 25,000. Now we have 10,000 for account payable. Common stock and expenses didn't change. Our balance sheet is still in balance, 58,500 plus 2,500. I'm sorry, 25,000. Well, that still equals 83,500 on the left side. 10,000 plus 7,500, that's 85,000 minus 1,500. Oh, that equals 83,500 on the right-hand side too. So our balance sheet equation is still that, in balance. Let's move on to D. The company completed work for a client and immediately collected $2,500 in cash. So what accounts were involved in recording this transaction? Well, we know that cash is involved because the company got $2,500 of cash. They got that for doing work for a client. Oh, that sounds like something that the company's in business for. That must be service revenue. So, or revenue as we have on our account here. So the two accounts involved would be they've got revenue now and they got more cash, $2,500 more of cash. So the two accounts involved would be cash, which would increase by 2,500, and revenue that would also increase by 2,500. Okay, let's update our balances again. 58,500 plus 2,500, that's 61,000. No account receivable still. Equipment is 25,000. Accounts payable still 10,000. Common stock still 75,000. Nothing for dividends, but revenue is now 2,500 and expenses 1,500. And if we add up the assets, 61,000 plus 25,000, well, that's 86,000, and that equals exactly the claims on the assets. A $10,000 creditor claim plus combined equity claims altogether also equal $86,000. Alrighty, let's move on to transaction E. Notice that on this slide I just carried forward the ending balances from the previous slide of cash of 61,000, no receivables, equipment 25,000. Notice we still have that asset total of 86,000. Accounts payable of 10,000, common stock 75,000, dividends of 0, revenues of 2,500, and expenses of 1,500. So we're all set up now to move on to part E. It says the company completed work for a client and sent a bill for $8,000 to be received in 30 days. So let's step back and let's think, what accounts were involved in this transaction? Well, we've got that work for a client again that we saw earlier, so that must be we've done some work, we've earned some revenue. Okay. Did we get cash? No, we didn't get cash, but instead we sent a bill to the customer for $8,000 to be received in 30 days. So we're going to have a receivable. We've got an IOU. We didn't get cash now. We'll receive that cash when? In 30 days. So the type of asset that we have instead of cash is we have an asset called an account receivable for $8,000. And remember, revenue for the work for the client also is $8,000 as well. Both increase, and now we update the balances. Cash of 61,000, receivables of 8,000, equipment 25,000, accounts payable of 10,000, common stock 75,000, still no dividends. Revenues have now increased to 10,500, and expenses are at 1,500. Is our balance sheet still in balance? Do the total of all the assets equal the claims on those assets, liabilities plus equity? Well, yeah, 61,000 plus 8,000 plus 25,000, that's 94,000. And that equals 10,000 plus 75,000 plus 10,500 minus 1,500. Yep, that's 94,000 as well. So assets does indeed equal liabilities plus stockholders' equity. Let's move on to transaction F. The company purchased additional equipment for $6,000. So you know the drill by now. What accounts were involved in this transaction? Well, hopefully you said equipment and cash. And what happens to equipment? Well, they've purchased it, so they've got more equipment, so equipment must be going up. What's happening to cash? Well, they used up cash to purchase the equipment, so it must go down. So cash goes down by 6,000, equipment goes up by 6,000, and we update. And our balance sheet is still in balance because we had one transaction on the left-hand side that reduced an asset account, but still on the left-hand side another account increased. So those two offset. So notice that really total assets, the total of all assets, it didn't change at all. And liabilities and equity, those weren't even impacted, were they? So they definitely did not change. So our balance sheet account is still in balance, just with a reduction of an account on one side and an addition to an account on that exact same side. Let's move on to G. It says the company paid an assistant $3,000 cash as wages for the month. Okay, so cash did what? Cash went down by $3,000. Wages for the month, well, that's wages expense. You pay your salaries to your employees for working for you, and that increases by $3,000 as well. Cash goes down to 52. Receivables and equipment are both the same. Accounts payable, common stock, dividends, and revenues are still the same. And expenses have now gone up to $4,500. For item H, the company collected $5,000 cash as a partial payment for the amount owed by a client in transaction E. So recall in transaction E, we sold some stuff, but we sold it on credit. We're going to collect that credit, collect that IOU, collect that account receivable later on. Remember we set up an $8,000 IOU? Well, the customer's paying off some of that IOU. They're paying off $5,000, so that IOU balance has to do what? It has to go down. So we're going to reduce that IOU balance called the account receivable by $5,000. And what do we get more of from the customer? Cash. So cash goes up by 5, receivables goes down by 5. Nothing else has changed except those two accounts. Receivables are now $3,000 and cash is now $52,000. And what's the total of all of our assets now? Well, that'd be $86,000. 52 plus 3 plus 31 is 86, and nothing over here changed, and so that still equals the same $86,000. Alrighty, let's move on to the next transaction. Transaction I, the company paid $10,000 cash to settle the liability created in C. So I went ahead and put this up for you because it's getting a lot of information on here now. Remember that liability? We are liable for $10,000. We bought something on credit. Now we're paying that off. We have an account that we're going to pay off later on, and transaction I shows that account for $10,000 being paid off. What happens to cash? Well, that goes down by $10,000 as well. We update our balances, and cash is now at 47. Accounts receivable and equipment haven't changed, but looky here, accounts payable have now been zeroed out. All of the other accounts stay the same, and our balance sheet account is still in balance. Well, the last one up is transaction J. It says the company paid $1,000 cash in dividends to owners. So what accounts involved here? Well, cash and dividends. We have those two accounts already set up. Cash goes down by $1,000, dividends goes up by $1,000. We simply put those transactions in and update our balances, and we've done it all. Congratulations. That completes exercise 1-3, identifying effects of transactions using the accounting equation and this handy dandy worksheet.